All right, John. Today we're going to be talking about the 12 quiet killers in multifamily real estate. So these are the things that when most operators go in to buy a property, it's just they don't think about. So we're going to be sharing some of our experiences, John, from the 500 rental units that we currently have right now in our portfolio, and we're adding quickly. And the senior team that we've been able to build, we've just we're able to get ahead of a lot of these. But I think that for anybody that's investing into real estate, this is going to be a phenomenal episode that's going to be talking about the things that generally aren't talked about.
That's
But
right.
it's really good to be here with you.
Yeah, Mark, good to be here as well. To your point, right? I think the first thing you and I discussed once we sort of built the sort of framework and the outline and our kind of like thesis for our business. The first thing we did is we went out and started building the team, right? We knew that we needed to
Yeah.
have strong people around us that, had maybe more experience or deeper experience, and a track record of success in this industry. And so, a lot of these, thankfully, that knowledge was brought with them. And of course, you and I, having invested in real estate personally over the years, we're aware a lot of these. But the reality is, for example, Mark, I've been on property tours where, perhaps I spent about 30 minutes with a broker touring the property, viewing a few vacant units. And it was interesting. In one example, the guy had scheduled back to back, and I was still there after the tour, just walking the property, looking at the mechanicals, the HVACs. I kind of noticed like, why is this junction box open? And why are there random wires everywhere, right? And taking photos and sending them to our GC. And my point is these other groups came, did the tour, and left, right? And so, perhaps maybe the deal wasn't for them, and they just didn't feel like spending that additional time. But it kind of illuminated that, our due diligence begins well before we even submit a LOI, right? It's even before the property tour, right? Looking at the submarkets and the markets and things like that. But these hidden deal killers, if not properly accounted for, could take a great deal and just absolutely kill it, right? And so if you're not looking at all 12 of these things as part of your underwriting process, you're exposing yourself and your investors to significant risk.
Yeah, 100%. And that's where if you are investing, we'll just say on your own, and you're looking to go from like never purchased real estate before to, oh, I want to buy 100 unit apartment building. Uh, there's so many little things that can get you. And this is where we highly recommend you either partner with a group like us and you let us do all the work and we already have the team, or you start smaller, as in you buy like a one or two units if you're hell bent on doing it on your own, to because if you'll learn these as you go, and
Yeah.
if you have a mistake, then it's not going to wipe you out the same way. And then the third option is, if you can afford it, and is to actually go out and find talent and hire them and bring them on or partner with them. And when it comes down to partner, you just got to be very careful on who you
Yeah.
partner with, because bad partnership can really wipe you out and sap your energy. I'll just tell you,
Yeah.
it's like if you think that partnering with somebody in business is, completely different than, picking the wrong spouse. I mean, they're both super important. We'll just leave it at that. I'm not going to get into what's more, I think spouse is more important, but picking your business partner, John, you get the wrong business partner and you start building a business, to unravel that is a horrible experience that can just sap like a decade
Yeah.
out of your life. And so this is where these killers, these 12 killers we're going to be talking about, are some of the things that we've seen that are easy to overlook. And I think will just provide a lot of value for the listeners and some further insights on what to look
100%.
for.
And in truth, this applies to maybe somebody contemplating just buying a single family rental property, right? Like these same deal killers are in those deals, right? And so this will really be applicable to every level of investor, whether it's your first rental property or you're investing in large apartment deals as a limited partner with groups like Faris Capital Partners, or maybe you're out there doing it yourself, right? Buying a multifamily building. So the first one is, it's interesting. You would think it would be sort of obvious, but property tax reassessment shock, right? And what I mean by that is that a couple of things. So in the United States post pandemic, a lot of municipalities actually froze the valuation. So to provide relief to owners, they said, look, we're not going to raise your property taxes for a period of time. And so, if you're underwriting a deal and you're just looking at what the current owner's paying for property taxes, even if you assume it's going to increase by 10 or 20%, right? The reality is what we do at Faris Capital Partners is we actually go to a third party tax consulting firm. Now, we like Ryan Tax Services. They do a great job. In fact, what they'll do for us after the acquisition is go argue for a lower assessment on our behalf. There's ways they can do that by separating out sort of like personal property from the real property, the actual real estate asset itself. But the reality is that a couple of things happened. Those freezes have now stopped. So some operators have seen massive increases. So that could be a problem for a current owner. But when we're buying a deal, we need to know what is the good, better, and best option or solution, like the most likely, right? So Ryan Tax Services goes out. And the bottom line is what usually happens is the municipality just looks at the sales price and says, well, that's the new value. And so based on that new value, this is what your tax is going to be based on as a calculation of the current millage rate, right? And so Ryan Tax Service provides that information for us. And so when we underwrite, we actually go with the worst case scenario, right? And hopefully through their negotiation process and that reassessment process that they run for us, we see some relief. But we just want to make sure that we don't miss, because at the end of the day, if we miscalculate our property tax by 40 or $50,000 a year, that could be a deal killer. Our returns will be significantly different, right? So making sure you're not just making an assumption about what the taxes are looking like. You go out. I mean, look, it's $1,000, which is a lot of money, but in the context of one of these deals, it's a drop in the bucket. So it's well worth that investment to know exactly what we'll be dealing with, and then also know behind the scenes they'll be working on our behalf to help argue for a lower tax assessment. But it is so critical you get that correct. So it goes back to, you're buying a single family rental. You can't just assume the property taxes are going to stay the
Yeah,
same. They are going to
exactly.
go up, right?
Yeah, so taxes, and the next one is insurance outside of your debt payments, so
Yeah,
your mortgage payments on any sort of real estate that you own. Taxes and insurance are two of your largest expenses on it, and so your insurance, what you're getting is also very, very important that you nail that down and what's in the fine print, and what are your deductibles in this. So we had one experience. We had invested in another group, and the deductible was we'll just say it was a lot higher, and there was a storm that came in, and the roofs were damaged. Well, the deductible to get everything fixed was it was well above $1 million, and so that was a big issue that was not factored in, to pay a little bit extra and have a little better coverage for those we'll say catastrophic issues that potentially can come up. Like, you want to be able to close that back door and seal that off just in case. And so that's where, for us, one of the things that when we're looking at insurance, first off, having a good insurance broker is worth their weight in gold that specializes in multifamily, and having a great relationship that will actually give you guidance and counsel, not just an order taker. The
yeah,
other thing is, so in our deals, it's like $25,000 deductible, right? So we factor that in. If we do need to pay that deductible, it's like that is manageable, and we'll still hit our key metrics if something comes up. We also want insurance that is not only covering the building, but income loss as well. Like, think about it: if there is a storm and your residents are forced out of the building, and they can't come in for a number of months, like, you're losing income there
yeah,
essentially, right? And so that's where that needs to be factored in as well. But you want to make sure to look through the fine print, have a really good insurance broker that is advocating for you. And if you get your taxes and your insurance right, and when it comes down to your underwriting, and that you're projecting a conservative number, that is that you're well on your way if you can get those two right.
yeah. That's it. And you touched on it, like certain things like named storm coverage, obviously flood insurance, right? In other words, you could be in an area that is not in a flood zone that still experiences flooding. Like perhaps maybe a storm drain is clogged, right, and it backs up when a big storm comes through. So making sure you are not looking to this is not an opportunity for cost savings, right? You have to get full coverage that will make sure that your investors and the operations are protected. And one benefit, though, is that there's things you can do to influence that. So I look at our Largo property as an example. It's in Tampa. that area is prone to hurricanes. And it was interesting, in our first year of ownership, we had two named storms come through. And because we bought in an area that was not in a high risk flood zone, in fact, it's in terms of Florida, it's the best you can be in. It's called Flood Zone X, means it's not in a 100 or 500-year floodplain and it's like less than 1% chance of flooding. And so when we first closed on that deal, our insurance was like $1,850 a unit. I mean, and there was a minute there where we got a higher quote where it almost killed the deal, where we had to back out. But our insurance broker kept pushing, found a great program that Florida was offering. It was a state-sponsored program, and so I mean, we were choking on 1850, but the deal supported it. But because we operate the deal in such a way where we immediately come in and fix any potential challenges or issues with our 28-day transformation, we literally did some regradings to make sure that the land is sloping away from the buildings.
Mm,
We actually added some tie downs to the HVAC compressors, which was totally optional. The lender didn't require, I mean, I'm sorry, the lender nor the insurance company required it, but the insurance company suggested it. And so what happened is we had no claims even with those two storms, and our insurance cut in half. So that was a huge win. But guess what, Mark? We didn't sit there and reforecast. We said, you know what? There's a world that could exist that goes back up next year, right? So we take the win, but we don't, extract the cash. We keep it in the deal just to be on that safe side because you never know what can happen. But you nailed it, right? Your mortgage, your taxes, and your insurance are your largest expenses. And if you don't get those, three things right, the deal is going to, be dead on the vine, right? So hugely important you get that right. And for us, what that looks like is getting hard quotes from our insurance broker for multiple carriers before we even submit our LOI. And if you have an insurance relationship that does not want to do that work for you, you need to find a new insurance broker, bottom line. Next one is utilities and just sort of water and sewer, right? So for example, part of our process when we get the seller's financials is we go through and look for any spikes, right? And you might see water went up 25% in 1 month. Well, that's indicative of a potential flood, or not necessarily flood, I should say, but leak or some sort of issue, right? So we go to the broker and ask those questions. We also have to look at what's called RUBS, which is Ratio Utility Billing Service. That's what that acronym means. And what effectively that means for an investor listening to this is that we can actually charge back. So in some cases, the apartment building itself is not individually metered at the unit level. So like there's one pipeline of water coming in and electric. And so you charge back a ratio of usage to the individual resident, but every municipality has different rules on that, on how much you can charge back. And so what you may find is, oh wow, this looks great, they're recapturing all this money, and then we take ownership and realize we're out of compliance, and now we're like, have some exposure to some potential regulatory issues. So really understanding what the rubs are allowed in that area, how much you can charge back. Obviously, we go back as far as we can. We'd like to see 24-month of utility history. We do request that from the seller, and we just look for trend lines and things like that. Because one thing that's happening, Mark, and I mean, we somewhat touched on this on another podcast, just in terms of the costs that are rising. Well, they are building so many data centers to support AI in the United States, and this actually is very frustrating to me, but it's like somehow I'm paying for it and not the company building the data center. In other words, my electricity costs have gone up like 40% this year because Google wanted to build a data center down the street. If I were president, I would say, look, you want to build a data center, that's great, but you're paying your own costs here. But that's not what's happening. It's being passed on to the consumer. And so for us operating these big buildings, we have to recognize and understand our electrical costs will continue to rise, right? And so that all has to be factored in.
yeah, 100%. And then we're getting into the heavier lift capex invisible costs that potentially can come up. And this is one of the reasons why we like 1980s and newer, because you
Yeah.
get in the 70s and you're getting into cast iron, piping, poly when it comes down to plumbing is another one. You got aluminum wiring as well. Like some of these things are very, very expensive. And so it's like everything you can do an inspection and everything's looking fine, but then because it's so old, things can break. And
Yeah.
so if you don't factor in or at least have a budget for it or get it at a good enough cost basis and have enough cash sitting on the sidelines just in case, like we've seen other groups that just got smashed because they didn't factor
Yeah.
this in. And so this hidden infrastructure potential cost is where you can really get hit. And that's where a lot of groups are actually buying newer vintage. And that's one of the reasons why we like 1980s or newer. Now, we did buy one asset that's where the $90 a square foot, John,
Yeah.
as you know, where we bought in 70s vintage. And it was just such a good deal.
Yeah.
Like it was like $400 below market rents. And it was, we'll just say there's so much low hanging fruit on that asset. And we actually went in and did the inspections, and we saw what needed to be done. And we budgeted for that as part of our overall capital raise, is not only, for the cast iron, all the piping and whatnot, but also for brand new roofs right across the board. And so you got, roofs, you got, piping, you got, electrical. And so you really want to make sure that you budget for it. And even though that it's quote unquote fine right now, you have to, we'll just say, be ready for a worst case scenario. And if that does come up, like, just being prepared for it is a really big one.
Yeah, and that all comes down to due diligence. So, not this is not due diligence is not an opportunity to look for cost savings, right?
Mm,
So, you camera every main line. We look at all the building materials. In fact, regardless, and this is even when we've got the right plumbing. So, in other words, not cast iron. We still, flush the lines, clean them out, because what we don't want is backups or water intrusion because there was a clogged line, right? So this all stuff needs to be covered as part of your due diligence, right? And so you nailed it. There's really actually this moment, and it was really in like 1978 in the United States where the building codes changed significantly. And so over the next few years, a lot of this material was outlawed, right? And so you can't use it anymore, but it still exists in some of these buildings. And so this is all discoverable. So if you come in and just kind of do like a, I don't know, like a half-assed, due diligence process and miss this, you nailed it, right? In fact, our Charleston portfolio, we largely were able to acquire those units because the operator had bought a deal, not these deals, but it was a 70s vintage deal, and they failed to account for the plumbing system. And guess what happened? It failed. And the story we heard, it was over $1 million to repair, and that in and of itself killed that deal, which created a domino effect, which basically put the whole operator out of business. So what we bought, Goose Creek and Monk's Corner, was in a sense a fire sale because they were doing the right thing. Actually, they were saying, look, we made this massive mistake. We need to get out of all of our deals and get as much money of our investors' money back. And they just closed up shop. I mean, all on that one bad decision and that one miss, right? So critical that you look at everything. And when we're on site for due diligence, Mark, I mean, even the 66 units we bought in Georgetown, it was a 3-day process. We were looking at everything. We had plumbers, we had electricians, we had general contractors, roofers. We were looking at every last little detail, because we knew it was 70s vintage, and it's like we got to get this right. And can the deal support it? And to your point, because of that low per door cost, we could just budget those items in, and the property is performing magnificently. But if we just went in quick and fast and didn't account for those things and then realized we had to replace all the roofs or all the plumbing, our investors would have been put at significant risk. So it's all about crossing those T's and dotting those I's with the due diligence, and it's not a cost savings opportunity. This is where you spend the money to make sure you're looking at everything.
Yeah, for sure. So we're looking at number five. We're looking at the difference between physical occupancy and economic occupancy. So you could have it showing that it's 90% occupied, but the 90% that are there doesn't necessarily mean that 100% of them are paying.
Right.
So that's where economic occupancy can actually be. It can be lower. So let's just say it's 90% occupied, but there's like 5% that are delinquent in their rents. It's like, well, you can't factor in that, oh, there's 90% occupied when you 5% of them are not paying. And
Yeah.
so that's where knowing the difference between physical occupancy and economic vacancy and factoring that into your overall projections and performa is really important. You're always going to have, you got to factor in, you're always going to have some delinquency. There's going to be some people that just
That's right.
aren't able to make their payments. And so that's a really big one, knowing that and factoring that into the budgets as well. So The other one, number 6, is lender covenant. So the amount of cash that's actually needed to be able to move along, we'll just say the asset. So they have these minimums of debt service coverage ratios there, that there's certain amount of reserves that you actually need based on what your lender is requiring you to have. And in some cases you need to have an interest reserve there, where you actually need to have cash set aside, where in a separate account, that's basically letting the lender know, and that, okay, all the interest there is in an account and ready to be paid, month over month, and then those draws actually come out. So the amount of cash based on what your lender requires you to have is really important to get clear when you're going into any deal.
Yep, that's right. Yeah, if it, for me, we actually had a scenario where a deal we were buying in the contract process, the seller took the eye off the property and DSCR dropped. And so we didn't own it yet. But because of that, our lender imposed a $350,000 reserve on us. And, unfortunately, we had no control over that. The deal still worked, but that money was tied up for about a year. And so, that was a deal that, once again, we had the capital. We knew we could still deploy our business plan. That money's now back. We have that cash, and it's being deployed to renovate units. But that's a great example that sometimes these things can happen even when it's not your fault. So, it's kind of going back to that economic and physical vacancy as well. It's like you have to really understand what's happening at the property before you buy it, because going back to both of those scenarios, our Noonan property was a great example where the broker was very transparent on the first tour. He said, "Look, the current property manager has lowered their standards in terms of who they're letting in." So, in other words, we're typically looking to see 30% to 35%, income to rent ratio. They were letting people in at 20, 25%. And guess what? Because of that, there was a higher level of delinquency. And so, knowing that and baking that into our plan, we had a strategy on how to address it. So literally on day one of ownership, we were touching base with every single delinquent tenant. And in some cases, we were able to work out payment plans. In other cases, we recognized and realized they're never going to be able to cure this. And so we just started working out an exit strategy. Our goal is never to put anybody out on the street, but giving them enough time to say, look, like, we are going to have to evict. So why don't we help you find something that's a little more affordable for you? So that's our genuine level people in action. In fact, in Georgetown, we had a resident that had not taken great care of the property. So a little bit of a different scenario. He was paying his rent, but we needed him out. I mean, he was trashing the unit, and we took the time to help him find other accommodations. So, it's just that idea that you have to know this so you have a plan going in. If you showed up on day one and go, "Oh, shoot, I didn't realize 15% of the residents were delinquent," all of a sudden you're 3 or 4 months behind, right? So, knowing that information and having a plan is huge. The next one is exit liquidity and buyer depth. In other words, like, what is the future buyer for our asset? It's a conversation mark. It's actually one of the first questions you generally ask in these meetings, right? Like, we review the deal and sort of look at the high level metrics. And before we dive into the weeds and the details, the first question is who's the future buyer for this asset? So, for example, you might find a wonderful deal, but the submarket maybe doesn't have a lot of multifamily housing. Maybe it's 40 or 60 units. And so you're saying, likely an institutional investor is not going to come in behind us, right? Another syndicator might not be interested. So that might be a deal we walk away from, because we have to know we're going to have that buyer pool in the future. And so really analyzing beyond your ownership, like, who is that future buyer, and where will there be enough of those buyers out there? So in other words, if we have to rely on maybe just an ultra high net worth mom and pop style investor that wants to buy a stabilized asset and cash flow it, that's great. But there's much fewer of those out there than there are, say, operators like us or institutional groups like Blackstone that like to pick these deals up. So part of that, in terms of how do we control that, right? We do sensitivity analysis where we look at, cap rates as it relates to NOI. And, if NOI is here and cap rates are here, what would it look like, right? And it goes back to conservative underwriting, having strong reserves. and making sure that we're talking to brokers 6 to 12 months out from when we're actually anticipating an exit, so we can start to get some analysis from the broker on the buyer pool, what the market's looking like, and get some wise counsel. Perhaps the broker says, you know what, it might make sense to wait 18 months versus 12 to exit, right? So it's something you have to think a lot about before you take down the asset. Who is that potential future buyer?
Yeah, for sure. The next is vendor and contractor concentration. So this is where if you're totally reliant on one go-to, and if they mess up, for example, you got to be able to factor in that potential risk. And that's one of the reasons, John, that I really love what we do, in the sense that it's not, if we're renovating, let's just say two-thirds of the units we buy, like for example, our latest acquisition was 114 units. Our business plan is to renovate two-thirds of them, leave one-third for the next potential buyer, which opens up our buyer pool. So those, we'll just call them 80 units approximately. Those 80 units are not going to be all done at once, which would be more exposure. That's more risk. When you're spreading it out over a period of 2 to 3 years, if you run into a bad contractor, you're not, your pants aren't down, so to speak. And so we've seen this actually with other assets where they did a complete lease out. So they basically turned over all the units, and they were at like a 60, they broke their debt service coverage ratio covenants there with the lender, which is a big no-no. But then when they leased, they basically, they created about 40% vacancy, and then
Yeah,
they were renovating. They thought they'd just renovate them all at once and get it done. The problem there is when they when they were all vacant, the GC was not executing on the renovations, and and so what ended up happening was when they had this tiff with their GC, they were stuck with them
mm,
because they had so much exposure with that one GC. So this is where keeping your doors open to other vendors and other contacts and keeping relationships outside of who you're currently working with is just, to me, just good business practice.
yeah,
The other thing is like understanding where the risks are. That's one of the things, John, that I got from Sam Zell's book, is that he's super paranoid when it comes down to risk.
yeah,
And so he was able to analyze risk. And so this idea of like risk to reward investments. It's like anything that you're investing in, the harder it is to do, the higher the risk is
yeah.
when it comes down to your business plan. And so you got to factor that into your overall returns. And are you getting compensated properly for that? And that's where when it comes down to having these relationships and having that, we'll say more than one contact, whether it's your property manager or your GC, it'll mean that your risks are lower, and that if you do need to move where somebody's maybe dropping the ball, you can do it, and you're not, caught trying to start the process in the middle of it where time is of the essence.
That's right. I mean, just look at a unit turn, for example. So, our goal is to turn a unit within 3 to 4 weeks with a renovation, right? And so while that renovation's occurring, there's no income coming in for that unit, right? And so if that vendor starts dragging their feet, now all of a sudden it's 5 to 6 weeks, it's not just adding an additional 2 weeks of no income coming in for that unit. It's also the 2 weeks or 3 weeks it might take for us to get the resident into the unit, taking the lead, taking the tour, getting the signed lease, and then getting the move in scheduled, right? Because often if somebody comes in, signs a lease, but their move-in might not be for 30 days, right? Just based on whatever their needs or necessities are. So having vendors that can stick to your program, one of our core values of speed of execution, is critical. And so we've had situations where we've had some, vendor drift where they're not, moving as quickly, and we pick up the phone and we say, look, like your agreement with us was 3 to 4 week turns. We're falling behind. We don't get this corrected soon, we're going to be looking at other opportunities, other vendors to work with. And so keeping those relationships always open. And I would say going even further in the front end, we get multiple quotes from multiple GCs. Even if we like a group and we've used them, for example, we're working with this one group across multiple deals right now, but that doesn't mean they're guaranteed to get the next one. We're still going to bring out two additional vendors to get quotes and just compare. So, when you have a great relationship, it can be great, right? You can work together for years. But, what I found sometimes, Mark, is sometimes over time, vendors, without meaning to, can sometimes start taking the relationship for granted and just assume they're going to continue to get the business, and you start to see drift in the service that you receive. And so it's always important to have multiple quotes there. Another thing to think about, number nine, is what we call regulatory creep, or like just like ordinances, like local things happening on the local level. So an example I can give, it's sort of a one that's less prevalent today because a lot of municipalities have already sort of enacted this. But a number of years ago in Metro Atlanta, a lot of the counties started mandating low flow water fixtures, right? So toilets, showers, whatever. So limiting the amount of water, right? Trying to preserve the volume of water we're using. And what that could look like is, if that ordinance came into effect and you're already in your ownership of your deal, all of a sudden, every time you turn a unit, not even a renovation, just a classic turn, right? A new person coming into an already existing unit, it may mean we have to replace toilets and light and water fixtures, right, throughout the property. And so for us, what that looks like is really getting in tune with what's happening at the local level, looking at city council meeting notes, what's being discussed, what's being proposed, and just trying to get ahead of these things that may come up. Now, one thing you and I have touched on a lot of other podcasts is we generally are investing in red states. So for a Canadian listener, what that looks like is the Republican dominated states, which generally have less regulation and are more business and landlord friendly. And so because of that, things like rent control are less of a concern for us than maybe, say, if you were up in the Northeast or in the West Coast. So California is a great example where some municipalities have rent control, some don't, but the whole state seems to be heading in
Mm.
that direction, right? So that's why we don't buy there. But once again, there's other things that could come up, like low flow water fixtures that I've already mentioned. So just knowing what could be happening, what's being discussed, and what could potentially create a bottleneck. And I'll give another example, and this was one we anticipated too. But in Noonan, they actually require permitting for example, building a grilling station. So we knew that. So what that meant was our 28-day transformation would just take a little bit longer as we work through that permitting process. But because we knew that, we baked that into the plan. So if we just got caught flat-footed, and worst case scenario, what if we just started building it, and then some inspector comes out and goes, "You're gonna have to tear this thing down, get your permit, and then rebuild it." We just lost a lot of money and a lot of time. So knowing what's going on in the market is super critical when it comes to what's on the regulatory calendar and what's currently in place.
Right on. So just wrapping up our last three is we have online reputation. This is a big one. So with Fair's team, our other business, John, the resale side of it, we have over 2,500 five-star Google reviews. More and more people are looking when they are looking to they're looking online and they're looking at the reviews. And it's no different with Fair's Capital and Fair's Residences that we have, is that potential residents are going online and seeing what the current residents are saying.
Yeah.
And so getting ahead of this is really important. And so we analyze any new asset that we take on. It's like, is the current profile worthy of us continuing and putting our brand on and continuing to build on those reviews? Or in many cases, we actually say, listen, we want to start fresh. It's a brand new asset, new management, new ownership, and we'll just say that the past is not the present. And so that is a
Right.
big thing that we do, is we want to build a new culture and a new brand and a new reputation in the community and then online as well. So that's a big thing that we're very proactive at the beginning of taking on any asset, is analyzing where we're currently at and then having a game plan. How are we going to turn this around or start from fresh and build it, so that when potential residents are looking, they're not getting turned off based on what they're seeing online, because they will
Yeah.
go online, they will look at it, and that needs to be factored in.
Well, Mark, it's interesting, but studies have shown that the average consumer checks 6 to 7 sources before making a buying decision. So that could be like, maybe you're buying a new digital camera, right? You might go to Popular Mechanics and consumer reviews, look at Amazon reviews. But it's no different in the apartment space. They're looking at apartments.com, they're looking at Google, they're coming to our website and taking a look not only at the property website, but at the Ferris Capital Partners website, and we can see it. And so, having those good reviews is so critical because one of the reports I get on a monthly basis comes from Google, and it just shows how many calls the property's receiving. Because what's happening is most people will Google search the property address, or maybe say apartments for rent in Noonan as an example, And when they see our business page, they click to call if they're interested, right? And so that's tracked, or they click to go to our website. And so we look for month over month improvement in those metrics, right? And we've seen it whenever we, say, for example, acquire a property and the average rating is 3.5%. Well, one of the first things we do, in fact, we've recently changed our approach. We just start from scratch. We just kind of start with a new business page because we believe our asset is so different that it makes sense to do that. But in some cases, it's already sort of good. It's like 4.1. But the reality is, for example, we have a property we took and there was 55 reviews with an average star rating of 3.8. It would take us, 25-star reviews to get that rating up to 4.5%. So why take that risk, right? Start from scratch. You need to, I mean, 50, something reviews, right, that you might need to get to that rating. So it's so important. And obviously we want to tell the true story, which is when we buy a deal, it's a totally different property, right? So that reputational risk is huge. And what I love about that, Mark, though, is that in a good way, it puts a lot of pressure on the property management team to deliver excellent results for our residents on a daily basis. So it's actually one of the key metrics you and I get. Every review that comes through, Mark and I get directly. The same minute the property manager gets it, right? Next one is a bit of a smaller one. I mean, it's a super important one, but cyber security risk and payment risk, right? So frauds are getting so sophisticated, Mark. In fact, I almost fell for one the other day, and it actually really kind of frustrated me because I'm generally pretty smart about this stuff. But I received an email, and it was from support@paypal.com. So it wasn't like, oh, it looks like it's from PayPal, but it's from some weird email address. And so when I saw it, I'm like, wow, this is from PayPal, and it looked like somebody had bought an iPhone on my PayPal account. So I called the number, and what ended up happening is the guy did the thing that you're never supposed to do. He started asking me for the verification codes. In other words, when you log in and you get a verification code, and that's when it clicked. I'm like, something's off here. So I just hung up the phone immediately. I did more research. They had spoofed PayPal's address. So I'm sharing that story because these frauds are getting very sophisticated. In fact, even on the application level, there are now websites that a resident can go to and get a full fraud package built. I mean, in other words, fake pay stubs, fake based bank statements, fake everything. Now, we invest in very, I would say it's not ultra expensive, but we're paying a premium. And it's an AI platform that can notice the difference in the pay stub. For example, ADP, one of the big payment processors, they hide things in the checks that aren't visible to the eye that indicate it's a real check, right? So this AI can sort of detect that. But for example, if you don't have two-step verification on your email, somebody hacks into one of your property manager's emails and then starts taking rent checks and committing fraud with them. So you just have to have very tight cybersecurity measures in place to make sure all your email is locked down with two-step verification and protection, and strong property management software that can detect potential rental fraud, where, in other words, a resident provides us with inaccurate information. We let them in. I hate to say it, but the term is a professional tenant. There are people out there that know the regulations, they know the rules, and they know that in some municipalities they can move in with completely fraudulent information, but it's going to take you 6 months to get them out. So they live for free for 6 months and then vanish one night, and you're stuck with all that delinquency. So huge. Finally, team turnover, which I'll leave with you, Mark.
Yeah. This is a significant one. This is so big because
Yeah.
you can actually interview a company, but it's who's going to be taking the calls for our assets. Where one of the reasons why we like them with economies of scale is that the income coming in from them, because they're larger assets, 50 to, we'll just say 100 units up, is that we can have on-site staff, and who's taking the calls and who's converting the property manager on site is so critical. I cannot, I mean, in business, it comes down to your people, right?
Yeah.
But in this case, it's like who's taking the call and who's converting is who the resident is making their decision on, who's going to be the day to day, who's going to be my person looking after me. And if that person is not trained properly, if they are not good with people, if they have a bad attitude, it will kill your sign up rate. It'll kill your renewal rates because they don't like the property manager that's on site, and especially like your maintenance tech as well. These assets 100 units above, it allows us to have a full-time on-site maintenance tech, where if they're not out there changing and improving these maintenance requests speed and excellence, then I mean, I shared the story in a previous podcast of my barber is like,
Yeah.
he was so upset because his landlord, he's been chasing them to fix there's a leaky toilet, and finally he got his brother to come in to do it, and
Yeah.
he basically he signed somewhere else, even though he was paying really good rent at that spot. He was just
Yeah.
so upset that the maintenance request was not done, and that comes down to your people. So making sure that you're interviewing and that you're getting the right people at the beginning, because what I've also
Yeah.
seen is you get the wrong person is like, I'm going to try and change them and I'm
Yeah.
going to try and improve them, but then you've lost 6 months to a year
Yeah.
rather than just getting the right person from the start. Your team that you have on site is so critical, and if there's turnover or you expect there's going to be turnover, that needs to be factored into your overall return metrics when it comes down to
Yeah.
the financials, because you don't get the right people there, your conversions are going to drop significantly. The culture is not going to be what you want it to be, and the resident experience is going to decline. And that next time you need to go and raise the rents, they're going to think twice about paying you more money when they're not happy with the service that they're getting at the rents that they're paying in today's market.
That's right. Yeah, it's something that's come up a couple of times recently. I've been a guest on some podcasts, right? And so often the question comes up like, "What's the number one business lesson you've learned?" And I always say, "Spend 3 times more hiring than you think." In other words, you don't hire the first or the third person you interview. I mean, we just recently wrapped up a new hire to our leadership team, and it was about a 4 month process. In some cases, I talked to multiple candidates. I mean, it was probably about 10 candidates 4 times. So over 4 hours with these candidates to kind of then narrow it down to three. And then, you sort of stepped in. I mean, so with the gentleman we selected, I would say we probably spent over 25 hours with this individual before making the offer, and it's no different on the property management level. You get that wrong at the beginning, you're going to be behind the 8 ball. You get it right, and your results will multiply. And that's why I always tell people I don't look for an addition. Like, I'm not trying to hire somebody to add to our results. I'm trying to hire somebody that multiplies our results, right?
Man, that is
And
so good. And this gets to be more and more important as you're hiring a leadership position. I'll just like put that cherry on top there with John, what you just said, that the leadership, when are starting to oversee people, if you have a strong leader versus a mediocre leader, that strong leader, as they have like say 8 direct supports that are reporting up to them, if they're excellent, they will make all the 8 better. And that's where it talks to that exponential growth you were just talking
yeah,
about there. It's not just like by addition, it's like that the multiplication
yeah,
side of it. That's John, and that's been I think one of the main reasons for past success in business has been recruiting and getting the right people on, but getting the right leaders is the one of the ultimate leverage points in a
yeah,
business.
that's right. Well, Mark, I think we've covered, those 12 deal killers. And, if you're listening to this, this might be one you want to kind of, bookmark and go back to, especially as you're thinking about your next investment in real estate. If you're investing with Faris Capital Partners, we're always very transparent. We will, walk you through the entire business plan from front to back. But if you're talking with other operators, write down these deal killers and interrogate them on them. How are they thinking about taxes? What does the insurance cover? How have you conducted your due diligence, and have you uncovered any potential hidden risks? Right. These are very critical factors that if you get wrong will result in a very painful experience.
Yeah. And if you do want to learn more about partnering with us, go to fulloutinvesting.com. You'll see a sample deal on there, and then you'll be able to book a one-on-one call to find out a little bit more if this is going to be a good match or not in order to come in and get access to our next deal that is coming down the pipe, which we're actively looking for. We actually have an LOI on a property right now. And for 2026 coming, we're looking to be a very fruitful time to be buying assets. So go to fulloutinvesting.com. Thanks for listening in to the Multifamily Investor Playbook. We love and believe in you guys. Keep dreaming and investing big.